Hello students, welcome to my class. This is Professor Vincent Osaya and this is the presentation of part 1 of chapter 4, completing the accounting cycle. In chapter 1, we talk about the overview of accounting and the environment in which accounting operates in, and that is the business environment. Then in conclusion, we discussed how to record business transactions using the accounting equation format, and ultimately we prepared a set of financial statements. As you know by now, the financial statements contain valuable information that is used by both internal and external users for making decisions. In chapter 2, we zero in on how to record business transactions, how it is actually done in real life. We introduce journal, ledger, so on and so forth. Then in conclusion, at the end of chapter 2, we also produce a set of financial statements. Then in chapter 3, we talk about adjusting process. Recall, we said in chapter 3 that financial statements are not prepared haphazardly. We have to be systematic in doing so. In other words, financial statements are prepared systematically. You cannot perform or undertake step 5 until you are done with steps 1 through 4. So in chapter 3, we said one of the steps that we have to undertake, or one of the tasks we have to perform in preparing financial statements, is called the adjusting. So in chapter 3, we talk about the adjusting process extensively. Now chapter 4 actually completes the process of preparing financial statements. Okay, now that process is called the accounting cycle. So accounting cycle is the process for the preparation of financial statement, or accounting cycle consists of step-by-step procedure for preparing financial statements. Now, how many steps do we have? In some textbooks, they have 10 steps, some textbooks 8, some 6. Why the difference? Because every author arranges the task or the steps differently. But at the end of the day, we are doing the same thing. So for example, some textbooks will say first step is analyze and record transactions. So those are two things lumped in one step. That is why we have a different number of steps in different textbooks. But like I said, the bottom line is the process is the same. That being said, let's take a look at the objectives of chapter 4. The first objective is we are going to prepare the financial statement including classified balance sheet. Number 2, we're going to talk about worksheet. Number 3, number 4. So we have 7 objectives. So let's take a look at the first objective. Prepare the financial statements including classified balance sheet. Now, let's take a look at what that means. Now, how do we prepare financial statements? I just indicated that financial statements are prepared systematically. In other words, you have to do first thing first before the second step, so on and so forth. Now, here are the 3 main financial statements. Number 1, income statement. We said that income statement is a financial statement that reports how well a company performed within a period of time, or the performance of a company within a period of time. So that could be within 1 month period, or within 3 months period, or for the whole year. So the revenues and expenses are reported, and the difference is net income or net loss. Now let's take a look at number 2, statement of retained earnings. we said that the statement of retained earnings shows how retained earnings change during the period. Now, so what does that mean? So we talk about what retained earnings and net income are the same thing. Those two terms are used interchangeably. So net income is the same thing as profit. We used to call it a net profit. Now, so we need to know how much of the net income or how much of the profit the owner or owners retain in the company. So that statement of retained earnings will show that to you. Then the last one, the third one, is the balance sheet. We said that the balance sheet consists of assets, liabilities, stockholders' equity, and that balance sheet talks about the financial condition of a company at a point in time. So it is a snapshot of your financial position or your financial condition, be it a company or be it an individual like you or I. So those are the three basic financial statements for a corporation. The financial statements consist of assets, liabilities, and stockholders' equity. Moving along, let's take a look at what we have here. Recall from chapters 2 and 3, we discussed some of the initial steps that we have to perform to prepare financial statements. So, number one step, if this is an existing company, we start with the beginning balance of each account. Of course, here at the beginning of the accounting period, we have to start with the beginning balance. Then number two, we analyze and record or journalize transactions. Then number three, we post the transaction from the journal into the ledger. And number four, we prepare unadjusted trial balance. Unadjusted trial balance. Now, of course, if this is a brand new company, there will be no step one, so we have steps 2, 3, 4 will be 1, 2, 3. So I hope I didn't confuse you by saying so. But here is the bottom line. You need to review chapters 2 and 3 to refresh your memory as to what these steps are. All right? Now, in chapter 3, you remember we talked about adjusting process. After we journalize, by the way, let me go back to the steps. Remember now that we emphasize the why of each step. If you know the reason why you are undertaking each step, it makes understanding the process a whole lot easier. So, number one, we start with the beginning balance. Number two, we analyze and record transactions in the journal. Number three, we post to the ledger. Number four, we prepare unadjusted trial balance. Now, after preparing unadjusted trial balance, then number five, we now journalize adjusting entries. After journalizing adjusting entries, we post to the ledger. After posting to the ledger, we prepare another trial balance. This time we call it adjusted trial balance. So at this point in time, we have prepared two trial balances. One is unadjusted, this one is adjusted. So again, like I said, you need to go back to chapter 3 to review your work. So after preparing adjusted trial balance, we now launch the preparation of financial statements from adjusted trial balance. We talked about the implication of preparing financial statements from unadjusted trial balance. If you do that, your financial statements will be off, or you will prepare incomplete, inaccurate financial statements. So take a look at this diagram. Basically, by the time we have the adjusted trial balance, all we are doing here is we are pulling out the accounts for each financial statement that we discussed. So let's take a look at this. Here we have revenues, here are all the expenses. So we pull all this information out and prepare each financial statement. Now, let's take a look at the relationships among the financial statements. Now, each financial statement is related to the other. So let's take a look at the relationship. The bottom line of the income statement is net income or net loss. And that net income or net loss is part of statements of retained earnings. Now, the bottom line of statement of retained earnings is part of the balance sheet. So let's take a look at the demonstration of that. So here is the income statement. What is the bottom line? Net income or net loss. And this net income, net loss flows to the statement of retained earnings. As you can see, it is one of the items on the statement of retained earnings. Then the bottom line of statement of retained earnings is part of the stockholders' equity section of the balance sheet. So here you have it in terms of the connection between the three financial statements. Now, let's take a look at classified balance sheet. What does that mean? That simply means a classified balance sheet simply means that the assets and liabilities are reported in a specific group. Now, that being said, it is important for us to know here a couple of things before we explain that further. The meaning of liquidity. We said that assets are shown in the balance sheet in the order of liquidity. What does that mean? Liquidity measures how quickly an asset can be converted to cash. So obviously the most liquid asset has to be cash, because you don't have to do anything with cash to have it readily available to spend. So so liquidity measures how quickly and easily an account can be converted to cash. So now let's take a look at liabilities. Liabilities are classified as current, due within 1 year, or long-term, due after 1 year. So all the obligations of the company that are due within 1 year are called current liabilities. Those obligations that are due after 1 year, we call those long-term liabilities. Moving along, let's take a look at assets. All right. Now we are talking about classified balance sheet. The reason why we call it classified balance sheet, like I said, assets and liabilities are basically put into different groups. In this case, assets are put into two different groups: current assets and long-term assets. Now, that being said, here is an important term that we need to know: operating cycle. Now, don't confuse operating cycle with accounting cycle, which is the title of this chapter. The title of chapter 4 is completing the accounting cycle, and we said that the accounting cycle is a process, step-by-step procedure for completing the financial statements, whereas accounting cycle means something completely different. Accounting cycle is simply the time frame or the time that it takes you to spend money and get the money back during the course of doing whatever business that you engage in. So if you are in the business of selling clothes, how long does it take you to go to Europe or China, buy clothes, put them on the shelf, look for customers? Some of them will buy on credit. You have to chase them around to get your money. How long does it take you to spend that money and get the money back? That is the operating cycle of the company. Now, why is that important? That is important for you to know in relationship to the definition of current assets. We said current assets consist of cash and any other asset that can be used up or converted to cash within 12 months or within the operating cycle of the company, whichever is longer. So So we use the operating cycle to determine whether an asset is current or not, or long-term asset. So we have long-term assets not converted to cash or used up within. So whatever asset that you have that cannot be used up or converted to cash within 1 year period or within the operating cycle of the company, whichever is longer is called long-term asset. An example of this would be an automobile. A company bought an automobile or an equipment or computer. You can't use them up within a 1 year period. So we consider those long-term assets. So I think this would be a good point to cut off part 1 of chapter 4 presentation.